I guess what we could do is we could segue a bit into what it is that you do in your portfolios and about your funds in particular. And if you could just tell us a bit about what you do and et cetera, that would be great.
Yeah, I appreciate the chance to do this because we think we really have a unique structure to what we do. And we've got a process, we call it our QOR process for quality optimized returns. And so what we do is number one, at the highest level, we say our job is number one to generate better than benchmark returns with less than benchmark volatility and do that on a rolling 3-year basis. So that's our clearly stated objective. And then we start to backfill that and say, how do we achieve that, right, on a consistent basis? And to extent, how can we build a playbook that we can train people, bring them into a team and help drive this engine to achieve that goal? And if you just were to take all your factors that you ever hear about, from value, right, to growth, to momentum, to dividends, to quality, and all of those things, and say, okay, let's look over the last 50 years, pick your time frame, and just build portfolios off each of those factors. And then say on each month, then look at a rolling 3-year return. So you can generate all kinds of data points and say, okay, which of those factors most consistently generated a rolling 3-year number that was better than benchmark, than less than benchmark volatility, and quality would come out as your answer, right? And quality is defined by companies, obviously, with higher profit margins, very high return on equity, high return on capital, and strong balance sheets. And intuitively, that makes sense.
The investment landscape is changing very, very dramatically. Brick and mortar stores are going to be threatened by this, but meanwhile, e-commerce is going to be jumping through the roof. We have this conversation that we're having is through Zoom, and Zoom stock has gone up 4-fold or something like that over the last few weeks. Right. So what you have is you have quality yesterday may not be quality today, and quality today may not be quality tomorrow. How do you determine where to go, and how do you adjust your portfolios?
Yeah, no, it's a good question. We have a lot of structure behind that. So we have 7 business risk buckets that are sort of tap onto business quality. And so there's 3 that we would consider high quality, and those buckets we call they're good, elite, and defensive. And then we have 4 buckets that we consider sort of lower quality, but that we may want to participate in from time to time. And that would be quality cyclicals, commodity companies, high growth, and then we have a special situations bucket. And I'll come back to those because those are very important in our portfolio construction. But that's how we drive a conversation. So the important thing to your question, Simon, is we're talking about exactly that. So to be an elite company, it's high visibility on revenue. So there is the objective screening. You can say, okay, Bloomberg Terminal, show me all the companies that have a return on equity above 15% and are net cash, or whatever it is, right? And you'll get your answer. But then it takes an analyst and a team to say, okay, what's the future viability of this business? What's the risk of disruption? Is this a subscription-based business, or is it a capital spending-based business that's going to be sensitive to the economic environment? So we try to bucket those things, but that's part of our conversation, is reviewing if things are in the right, has the risk increased? And so we do think about that business fundamentally first in terms of disruptive risk. So that's a very important part of our process. And I mean, the second piece is then a price piece, right? So the 2 big risks we think about are business risk and price risk, right? And so for every business from every bucket, we then need to assign it a fair value. And that's when we're talking about, things that were expensive. We've got our guideposts in on every business to say, here's our line where we think it's expensive above this, and it becomes attractive below this. So we're really trying to combine that mix of quality with value. But the biggest part of it is we run very concentrated portfolios, so know each business. And so it's a very good question, right? And our special sits bucket is there for those companies that we think might become the good and the elites of the future, but we shouldn't bet on that yet, right? And as soon as we think somebody's being disrupted, they might go out of the good category into the special sits or out of our universe if we think those risks are high enough. So that is something that we do monitor closely.
So one of the things that you're talking about is running a concentrated portfolio of great names that are categorized into good, elite, defensive, cyclicals, commodities, and special situations. Now, with mutual funds in general, one of the things is that you make an investment into a mutual fund, and then your money is pooled with others, and that basket is invested. And what that does is that gives you the ability to diversify amongst a number of different names. One of the biggest criticisms of mutual funds is that sometimes they become over diversified, where they've got so many names. And You'll often also find this in exchange traded funds where, you know, you're invested in 500 names or 2,000 names. You're saying that your funds, you like to run them on a concentrated basis. Can you explain what that means to you and what the impact would be
Yeah, so
for the investments?
sure. And so, you know, we target typically 30 to 35 names. So that's what sort of concentration would lead you toward. But we try to make sure we're reasonably well diversified within that. And we can certainly talk about some of the structure we bring to the portfolio building process. But we're not here to be like the benchmark. You know, the TSX Composite, I think, is 268 names. And of course, the S&P 500 has 500 names. So we're trying to really find unique, good ideas and let those ideas work on behalf of investors. And I think we have a maximum by regulation, a 10% weight in any given name. We would never go up to that, but we certainly would allow 6 and 7% weights in an elite business at a very attractive return is something that we would be willing to do. And so, you know, when you start to get those sorts of weights, you can see why, you know, you can get down to 30 names. But I think the important part of now tying in those quality buckets, it's only the names in that elite bucket that can be those big weights. So if something is a quality cyclical, it doesn't matter how big we think the return is, we will never own more than, say, a 2.5% weight in a name like that. So that quality and that business risk becomes integral to our portfolio construction process. And the benchmark construction does not impact how we build portfolios. So no, in a Canadian portfolio, we're happy to be zero energy, right? We'd be zero banks if we thought that made sense for us. We're not zero banks today. We are zero energy. But the point is, we're not looking to the benchmark for any sort of guide on how our sector allocation should be or what our big weight should be. We're trying to generate a very different experience here. Again, to that objective of doing better than benchmark performance, but not adding volatility in doing that.
So how is it that you figure out what your performance is if you're not worried about benchmarks and benchmark performance? How do you judge whether or not you've done a good job?
Yeah, and certainly the benchmark comes in as a comparison. And we really see it as, you know, if we're all going to take different vacations, let's all go to Disney World, assuming we're allowed to again at some point. But let's all go to Disney World, and then we have a basis of comparison. So you can go off to, you know, Belize or wherever it is, and I can go to Costa Rica, and we could say, well, what was it like? Well, you know, the beaches were better than, you know, what we saw when we were in Orlando because they're ocean, right? And so the benchmark gives you that common point of comparison. And so we acknowledge that it's there. You know, it's not as if we pretend it doesn't exist. In a broad basket like a benchmark is an option for people. You know, again, we're trying to create a very, I wouldn't say different experience. We're just trying to generate returns for people, and we know the path is important. So, you know, if we do a 12% return and the benchmark does 10, but we're up 80 one year and down 60 the next year, and no one survives that, right? And so it's important that the path is also critical. So we think about both of those things. So we're happy to be compared to the benchmark because it's, you know, call it a competing product to what we're doing. But we just have a strategy that says it's more like golf, right? This is not what you do as a competitive golfer does not impact my game. I just need to make sure, you know, our game is as good as it can be.
One of the things I would like to steer away from, but I'm not sure that I can, is, you know, some suggestions about some companies that you may have found attractive recently. The one reason why I don't like it so much is that, you know, when people get a stock tip, that's one point in time where things are working. It's not necessarily going to be like if they stop tracking something, then they can get in trouble. So whoever got a stock tip to buy an energy company in 2003 and has held it all the time has seen their money go up and then get completely destroyed again. It's important to be always monitoring your investments and figuring out whether or not you're still holding the same company that you thought you bought in the first place. But where are you seeing little sparkles of value right now?
Yeah, and I would say, you know, now is one of those times where you're seeing a world of opportunity. And, you know, what we find is say the market 2 months ago, it was difficult to necessarily find quality names at prices that we thought were going to generate very attractive returns over the next 3 years. Those opportunities are now becoming plentiful. And so we've talked about some of those names. I mean, it can be the Johnson & Johnson and the Amazons have become attractive. You know, in Canada, there's a company like a Constellation Software, and we like them because they're great acquirers. But when everything's expensive, it's tough for them to put their magic to work. But in a market where there is business stress, where now people that are running small companies and are really starting to think about succession and long-term planning, a shock like this will make them more open to having a partner come in on the ownership level. And so this is creating opportunities for different types of companies. But I think that the big point is, those didn't exist 2 months ago, and now they're everywhere. And so now you can be selective on what are the near-term risks that we may want to mitigate. And maybe you want to buy, a restaurant brand which runs Tim Hortons, for example, right? Because it's under duress right now. But ultimately, people will probably be buying coffee again a year from now and going into a Tim Hortons. So those opportunities can come up as well. And then it's just knowing what the near-term risks are that you might be taking. But I think your point, and I'd agree with it, we like people to think about our process. We're always trying to rotate to where the best return opportunities are while maintaining a quality bias. So something that is a great pick today, Johnson & Johnson could easily be up 40% by the end of the year, and we're out of that position.
The interesting thing about finding the individual names and when I'm in conversations with people, it's capturing people's imaginations. And when you talk about a QS which runs Tim Hortons, or you talk about a Johnson & Johnson's, or you talk about an Amazon, those are things that people can see and feel and touch, and they know it exists. And so there's a comfort level there. When you're talking about a mutual fund, it becomes more esoteric because people don't actually know, like they don't feel the ownership like they would. They're not getting annual reports from all the companies inside of the mutual fund. And meanwhile, when you're actually inside of a fund, there's so much risk mitigation going on, and there's the potential to have really good returns, but again, with lower risk. But at the end of the day, the diversification benefits of owning a mutual fund are fabulous because you're taking out the risk of one company or two companies blowing up. And it's important to continually monitor these things. And it's important to have a really deep understanding of these companies rather than just, those are the Band-Aids that happen to be in my drawer.
And yeah, I can add some content because those are all things we take to heart, picking a concentrated portfolio. And so the one thing I'd really want to bring up to speed on is part of our process is we've calibrated how we look at companies. So everything gets put into one of these 7 quality buckets. Then everything gets assigned a fair value, right? So the analysts go to work and they say, if we're Warren Buffett buying the whole thing, what would we pay, right? And so we come up with a number. And then it's how wrong could we be, right? So we come up with our error bars. And those two things then will ultimately drive a risk-adjusted return, right? Comparing that fair value with the error bars to what the current price is. We then rank every company by its risk-adjusted return. So now you've got a list of every name from highest return to lowest, all with a quality tag and everything with a sector tag, as well as a liquidity tag. How easy would it be for us to buy and sell that stock? We actually then have a robo PM we use. So we embrace the use of sort of data and big data. And we actually this is where the best practice comes into view. We say, let's take everything we know about building a good portfolio. We should have a quality bias. We should have a minimum of at least 6 different sectors, maximums by every sector. Give the computer enough information, say, build the highest returning portfolio you can with all of these constraints, right? Sector, quality, liquidity, all of those things. And that becomes the recommended portfolio. And we review that as a team every week. So every analyst, while they may be covering consumer, they can see how their stocks rank against technology stocks. And we can talk about the error bars and all of those things. And is that list making sense? And is that portfolio the one that we think best represents it? And so then my job is to either execute that portfolio or provide additional insight, which could be on the macro environment that we're going to underweight the brick and mortar consumers here or whatever it is. But the point is there's a lot of structure around the things that you're talking about, how names can be very attractive one day and just on price movement could be very less attractive 6 months from now or a year from now, let alone the business could shift, right? There could be disruptions that may indicate that what we thought was elite with a great growth prospect, there's now a new competitor that seems to be very impactful in that market, and we need to adjust our view. And so we review all those things continuously, and why we want sector experts looking at each of their ideas. But that's now, I hope the whole picture's coming together. We're always rotating to that best opportunity set while managing diversity within concentration and maintaining a quality bias. And again, to achieve that rolling 3-year objective.
This brings me to, a number of different commercials I've seen over the years that really drive me crazy for discount brokers. You know, why don't you do it yourself? Investing is easy. Just buy the index and go to sleep and save money on fees. And people don't understand how much work actually goes on behind the scenes in order to make sure that risks that people don't even know that they're taking are being managed. Your process, to me, rings so true as an investment advisor. And it's extremely important to always have a process and to have a team and to have monitoring. And just my comment on fees and mutual funds, like this is what you're paying for. And I know when I look at your returns over the course of the last few years that you've done a tremendous job and that the process that you have is actually working. What thoughts would you want to leave people with? And these are people that may not be very up to date with what's going on in economic markets. This is a very trying time. What thoughts would you have to leave with people?
So I think there's a few key thoughts. And one is that when you look at making the return on equity markets, if you look at the S&P 500 over, call it the last 80 years, you would have made an 11% return, total return, including dividends. And so those are the sorts of attractive returns that we all want to gather, and why we expose our hard-earned money to equity so that money can grow faster than it can grow just if we're putting our own time in. The key to making those sorts of returns is the discipline, right? There's better and worse times to go into the equity markets. And they say a lot of the returns of that market are generated on very few days. And so the risk of being out of the market can be quite significant, but it also means there's opportune times to really be in the market when larger returns are generated. And our view is now is one of those times. And you don't need to call the bottom exactly. What you do know is that stocks are a lot more attractive now than they were, a month ago, right? This has been an incredible, March is called the full cycle month, right? The 3-year week. It's just been an incredible time, but it's shocking and it's painful, right? It's not doing what it's supposed to do. If you buy a toaster and your toast light's on fire, you don't want it, right? You buy stocks and they go down. That's not what you bought them for. But you can't go swimming and not get wet. Stocks are going to impose volatility on you, and it's very important to have the discipline to not only ride through that, but ideally even allocate in times of high stress. As we say, that often the hardest thing to do is the right thing to do when it comes to equity. And so now one high-level message would be is, if you're looking at allocating, at least bringing your equity weight back up to where it was, we would encourage people to do that. And then ideally do that with the partners that you really trust. So with someone like yourself, Simon, who understands the person's needs, understands their tolerance for volatility, and then people like us have to do our jobs and have to assure you that the companies we're buying are built to get through this. They're built to not just survive it, but ideally benefit from it. And that's what we're working hard to do in the background, is to making sure the risk is managed. And we do that with that quality bias rate balance sheets that can survive it, but further to say, who is ultimately going to be the winners 2 years from now after an environment like this. And so that's what we're working hard to do. And so ultimately people see the benefit of participating in equities. And so that's what we've been aggressive buyers here. And I think that's what we need to do. We need to have that discipline, but convey that message to say, if we can all partner up, we stand to make very good returns from here.
The partnership, the process, and the understanding that the volatility that we're seeing in the markets are actually what we can take advantage of, even in these tough times. Peter, thank you so much for your time. Really, really appreciate you spending a bit of time with me. We've had a few lag issues here, so the ultimate edits of this is going to be interesting, but you've shared a lot of thoughts, and thank you very much.
Oh, Simon, listen, good to meet you. Good to talk with you. If you want to follow up on any things that the message wasn't clear and we want to revisit, happy to do that. So reach out and we can backfill anything that you need to.
Okay, that's wonderful. Thank you, Peter. Stay safe and have a great day, great week, great month.
Okay, you too, Simon. We'll talk again. Bye now.